reconstrucción. Está con nosotros Massimiliano Bondurri, founder and CEO de SGMC Capital. Massimiliano, good morning.
Good morning.
What do you think about this context in markets, in stocks?
Well, what we're seeing is a big risk aversion, of course. So global investors are scared. And for the moment, they're right to be scared because, of course, there are a number of risk factors out there. Clearly, the geopolitical tensions in Ukraine, especially very high inflation. Now there's worries about potential recessions hitting the US and Europe. While that does not remain our base case, it is definitely a risk out there. And therefore, global investors need to reset their valuation expectations, need to reset the multiples. And that's exactly what we've been seeing with, of course, the higher beta, which means the higher risk part of the markets being hit the most, for example, in the specific case, NASDAQ, and the names which are a little bit more defensive are, of course, faring much better. And that's likely to continue over the short term.
What's your opinion about the concern about China?
Well, in China, we have a number of issues. Well, clearly, what is happening with respect to COVID is worrying. And the fact that cities and very important cities actually have been closed or are not being able to function normally, that is clearly a drag on the growth and the gross domestic product of the country. Hopefully, that is going to be improving over the next few months. But still, there is a drag which is there in the growth. Therefore, we expect the local government and the local central bank to continue increasing both the fiscal and monetary stimulus in order to try and get the country through this difficult environment. But of course, tensions and risks are there and are likely going to remain because macroeconomic numbers are going down.
What do you expect about Fed Act during this night?
Well, from the minutes today, we expect the narrative to remain the same as what they've said over the last few months. Therefore, a very strong focus in fighting inflation and especially inflation expectations. Basically, another 0.5% hikes over the next two meetings. But you can already see over the last week to 10 days, there's been a little bit of a change in the messaging. Therefore, in the past, you would always get a bit more hawkish tones coming out from some of the Fed governors. As of now, they're already starting to say that maybe once they get to 2%, they could look at pausing in September. And that's, of course, a fact given what is happening in the equity markets, because, of course, the tightening conditions are already there and have already tightened a lot since the beginning of the year. Therefore, they could potentially look at pausing a little bit in September. But as of now, we still think that they're going to continue hiking, and therefore the market needs to be prepared for that.
We will see an excess of high interest rate in Europe, in the European Central Bank?
Well, the ECB has been very clear that they're looking to increase rates already in the summer, and they want to get at least to that 0% level, if not higher. And that makes absolute sense. So it does make sense because they need to get this normalization kickstarted, because with the rest of the central banks of the world getting also into normalization, the European Central Bank has to do that, and it will likely will do that. Now, the question of how that is going to be impacting growth, especially in a European continent, which is not growing so fast as of now, that's, of course, a bit of a tricky question. But definitely negative interest rates might be something of the past already at the end of this year.
Thank you very much, Massimiliano Bondurri, founder and CEO, SGMC Capital. Good day, good business.
Thanks, same to you.
8:52 de la mañana.